do you protect your loved ones from extended family wahala when you're born? I'm sure you've considered writing a will, but you're reluctant because you think it's a complex process. Well, did you know that in the time it took me to make this coffee, you can write a will? Sounds unbelievable, right? Yet very possible. We believe that nothing should hinder you from leaving a good life behind for those you love. With Meristem Simple Will, you can write a will that protects your assets and provides for your loved ones from the comforts of your home. All you need is an internet link. To get started, visit meristemtrustees.com/simple-will. At Meristem Trustees Limited, we are committed to ensuring your legacy needs.
So when I did for MSL, I have a long list like that.
The fear of the future and its uncertainties puts a lot of pressure on people. Pressure of safeguarding their assets and caring for their loved ones. What happens to your hard-earned assets?
Doesn't stop now. It's 10.
Hello, everyone. Good morning, everyone, ladies and gentlemen, and our esteemed clients. We welcome you all to our 2024 Annual Outlook webinar. It's a pleasure to have you in our midst. The webinar is put together so that we can have conversations around the macroeconomic environment and also conversation around the market, both fixed income and equities market. 2023 came with a lot of drama, with major economies maintaining contractionary monetary policies, which led to moderation in global inflation, and then down to some defaults that we saw in the sub-Saharan Africa, and coupled with debt sustainability issues around sub-Saharan Africa that was witnessed last year, and then flowing into the domestic economy, where we saw major fiscal policy reforms that were implemented in 2023, issues around the fuel subsidy removal and also currency devaluation, which exacerbated inflationary pressure and lowered output growth during the year. And all of this situation had significant impact for the markets, both the fixed income and equities markets. And now, coming into 2024, you will agree with me that a lot of these dynamics that shaped both the global and domestic economy last year, some of them are expected to remain, while some of them are expected to change. And being informed about key expectations and projections is really pivotal to making the right decisions, the right financial decisions, and attaining financial success in 2024. And for us here in Meristem, keeping up to our promise to help you maximize your financial well-being, we bring to you this our annual Outlook webinar, where we bring together our experts, where they share insights into the financial and economic landscape. We are hoping to have interesting conversations today around the macroeconomic and the market environment, and also to provide guidance on strategies for investment positioning in 2024 for our clients and also for our prospective clients. All right, so we'll be starting this webinar with a welcome address by our very own delectable MD, Said Bashir. who is the Managing Director of Meristem Stock Brokers Limited. Without further ado, let's make welcome Said Bashir to the table as he takes his welcome address. Said, you're welcome.
Thank you, Samuel. Good morning, ladies and gentlemen, our esteemed clients, as well as our guests. It is with great pleasure and anticipation that I welcome you all to our annual Economic and Market Outlook meeting. As we gather here today, we find ourselves at a critical juncture in the global and, more importantly, the domestic economic landscape, which is marked by unprecedented challenges and opportunities. As we all know, the financial world is evolving rapidly. And of course, it is imperative for us to navigate these challenges strategically to maximize value that we deliver to our clients and partners. And in keeping to our brand promise in Meristem as a company that provides up-to-date market information to grow wealth in good time in an atmosphere of transparency. Our annual Outlook meeting serves as a platform to delve into the intricacies of the economic and market dynamics that we shape this year. Of course, the discussions and the insights shared today will not only empower us to make informed decisions, but will also enable us to adapt and thrive in an environment that demands agility and innovation. You would agree with me. And of course, we are privileged to have distinguished group of experts and thought leaders from our research team who have put this together, and they are joining us today to share their perspectives on key economic indicators, market trends, as well as investment strategies. And I believe that their invaluable insight will undoubtedly contribute to a deeper understanding of the forces driving the change and present us with foresight needed to position yourself, our client, for success in 2024. And as we embark on this journey of exploration and analysis, I implore us to let us foster an environment of open dialogue and collaboration. I encourage every one of you to actively engage, listen attentively, and of course, actively engage in discussion and challenge our assumptions and seek out opportunities that will drive our collective success. Once again, thank you for being here. We look forward to an insightful and productive session. Thank you once again.
Very much, Said, for that very fantastic opening address. I mean, like I mentioned when I started, and also if you listen to Said, he mentioned that we have a team of experts, basically from our research team that will be handling this webinar, giving us, deep insights into the macroeconomic environment and also the market for this outlook webinar for the year. All right, so I would introduce them one by one, just reading out their profile in no particular order. First of all, we have Praise Yanseken. Praise Yanseken is a certified chartered accountant with both ACC and ICANN, and she leads the investment research team at Meristem Securities Limited. She's well seasoned in macroeconomic analysis and financial markets, including equities and fixed income. She has also appeared as a guest on several news media, providing insights into the macroeconomic and financial market trends and outlook, helping investors make informed investment decisions. She was trained primarily as an economist, and she possesses strong quantitative and analytical competence. Praise Yanseken, you're very much welcome. We also have Sodiq Safiriyu. Sodiq holds a first-class degree in accounting from Babcock University, and is also an associate member of the Institute of Chartered Accountants of Nigeria. Sodiq is currently a senior investment research analyst with Meristem Securities Limited and leads the fixed income desk of the research team. His experience spans across the research, finance, and investment management. And for leisure, Sodiq enjoys watching football and surfing the internet. You're welcome, Sadiq. It's a pleasure to have you. We also have Esther Otunsoya. Esther Otunsoya holds a first degree in business education, and she also holds an MBA in finance accounting from the University of Ibadan. Her experience spans across accounting, research, and project finance. She primarily focuses on coverage of the energy, telecoms, and other financial services sector. For leisure, she enjoys watching football and also reading books. You're welcome, Esther. And we also have Felicia Awolope. Felicia is a graduate of statistics from the University of Ibadan. She has a diverse background encompassing research, finance, and investment management. She currently provides oversight on the macroeconomic environment, as well as the consumer goods and health sector. Felicia, you are welcome. We would be kickstarting the presentation right away, starting from the global and domestic macros and moving on to the markets, the equities and fixed income market, as well as giving out strategies for the year. I want to put it out there to our audience, both that are watching right now, that you can drop your questions in the chat box and in the Q&A. We have our analysts, that would answer the questions. So as the presentation will be going on, just ensure to drop your questions, your concerns, drop them in the chat box. We'll respond to them. And also at the end of the presentation, we also have a question and answer session. All right. Having said that, join me, make welcome Esther Otunsoya. She takes the stage to give us the opening conversation around the global economy. Esther, you have the floor.
Thank you very much, Samuel. So beginning with the global macroeconomic landscape, 2023 proved to be quite resilient for the global economy, despite several challenges that emerged during the year. So initially in early 2023, there were concerns about the likelihood of recession occurring in about 1/3 of countries across the globe. But we see that these speculations were put to rest as major economies have been on the growth path since then. And some of the major drivers of this resilient growth are the increased consumer spending in the United States, increase in services demanded in Euro area, as well as improvements in global supply chains. So contrary to what we saw to the expansion seen in the global services sector, there's been contraction in the global manufacturing sector, and the major drivers of this in that growth is basically the elevated borrowing cost, and this is owing to the high interest rate regime across major economies. We also saw the impact, the weak demand in China amidst their property sector crisis, how it contributed to the slow manufacturing activities in the globe. So as a result of this, the global manufacturing PMI, which is an index that basically tracks the manufacturing activities in the world, remained below the 50-point benchmark all through 2023. Regardless of this, the IMF projects that the global economy will expand by 3% in 2023. So for our outlook for 2024, we anticipate a slowdown in global growth rates. Our expectation is hinged on some existing factors and even some new ones as well. So we foresee a continuous pass-through impact of the elevated interest rates across major economies. So we expect that these high interest rates will continue to hinder business activities and growth prospects across major economies. Another factor that influenced our projection is the ongoing geopolitical tensions. So although the effect of the Russia-Ukraine war has waned significantly, the current escalation of the Israel-Hamas conflict would also have harsh consequences on supply chain, which could lead to disruptions and global economic growth at large. In addition to these considerations, we also looked at the fact that a significant amount of the world's population will be conducting elections this year. So the outcome of these elections would most likely impact economic growth, because we know that when new administration comes in and assume their offices, there will be some changes in policies and reforms, and this is expected to impact growth in these respective countries. Now, as the global economy expanded in 2023, the global inflation rate trended lower. And we see that major monetary authorities across the globe maintained an hawkish stance in 2023. And this has been successful in reining in inflation from its record high levels. So specifically, inflation rates began to decelerate in the second half of 2023. It dropped to about 6.9% from 8.7% recorded in 2024. For our expectation for inflation in 2024, we anticipate a continued deceleration in global inflation level, and this is mainly to be driven by expectations of lower food and energy prices, and also the continued impact of monetary policy across major economies. While there are concerns that there might be a reversal in the disinflation trend we've been seeing since the half year in 2023, we believe that the slowdown in nominal wage growth in major economies like the US, Euro area, and UK would keep inflation on its downward trajectory. So in spite of our optimistic outlook of a disinflation trend in 2023, we note that there is a possibility of some supply chain disruptions at the Red Sea and the Black Sea. And this is primarily owed to the ongoing crisis in the Middle East, like I mentioned earlier. I mean, if the escalation that we are seeing right now should continue throughout 2024, there's likely to be shocks that will drive like energy and food prices upward. And this directly feeds into inflation expectations. So this poses like a downside to our expectation. So in line with our expectation of disinflation for 2024, we foresee that major monetary authorities will be more accommodative this year. Like there'll be a likely continuation of holding rates as we've seen in the later part of 2023, and we this is just to enable them maintain the balance between price stability and support for output growth. So subsequently, though, we expect central banks to begin cutting their respective rates in the second half of 2024. This is unless if there's any other significant risks that comes up during the year. So while global growth and inflation directions were favorable for major economies in 2023, the global trade remains dim. So, and this is owed to weak demand primarily in China amidst its property sector crisis, and also the disruption caused by warring tensions like we've been seeing. Also, the increase in the value of dollar made imports more expensive for countries that are majorly reliant on importation, and eventually this contributed to the deceleration in global trade growth. So the World Trade Organization estimates that global trade growth would decline by 0.8% in 2023, and this is as compared to 2.7% in 2022. So for our expectation of global trade in 2024, the WTO, the World Trade Organization, expects global trade to grow by 3.3% in 2024, hinged on anticipated economic recovery in China. But we at Meristem Research, we foresee a lower than expected trade growth, as we do not expect a significant improvement in global trade levels. And this is because the potential downside risks are still kind of more than the positive, and it's like outweighing the positive. So for one, there's the heightened risk of global trade fragmentation, as major blocs like the BRICS continue to solidify their control over global supply chain. Also, the power play between China and United States that we've been seeing for a while now might actually impact trade during the year as well. So other factors that contributed to our dampened outlook is the adverse weather conditions in major food producing regions, and likely volatility in oil prices. So our outlook on oil prices in 2024 is we believe that The OPEC Plus is already taking proactive steps to maintain price stability throughout 2024. And this is using oil production cuts that began this January for the first half of 2024. And we expect that this would play a key role in determining prices in the near term. But there's still the possibility of shocks that can arise due to supply impact on supply flow, basically from the tensions we are seeing arising in the Middle East, and this is likely going to feed into higher oil and energy prices. So basically, for the global economy, for growth and inflation, we expect favorable direction in 2024. For both global trade, we are still not quite optimistic about the direction of global trade in 2024. This brings the end of the global presentation. My colleague Felicia will be taking off from here.
Thank you very much, Esther, for giving us an overview of how the global space will look like. For the domestic economy in 2023, we saw various developments that shaped the economic landscape in Nigeria. We saw ranging from the cash crunch in the first quarter of the year, which restrained economic activities in the first quarter, to policy reforms that were enacted in the second quarter, such as the removal of fuel subsidy, the unification of exchange rates, which all led to higher costs of energy, transportation, and even operational and finance costs for businesses. All these had effects on the manufacturing sector, and output growth for the sector actually decelerated in 2022. In 2023, we also saw that, by Q3 2023, the fact that the CBN began a gradual phase out of interventions in the real sector, primarily to just focus on their priority, which is to stabilize price. Also, we saw the effect on all this, and it's exerted pressure on output for the non-oil sector. By Q3 2023, the growth for the non-oil sector was around 2.75% year-on-year, and this is down from 4.27% that was recorded in Q3 2022, and even 3.58% that was recorded in Q2 2023. For the oil sector, we note that, the various issues that has been plaguing that sector, the oil arbitrage activities on the oil sector, pipeline vandalism, and even the strike actions that we saw in the first half of 2023 by Pengasan, all contributed to lower output volumes for the oil sector. And this impacted output growth for that sector in the first half. However, when coming to Q3, because due to the resolution of the Pengasan strike by the NNPCL, which led to the restoration of about 275,000 barrels of oil per day, we saw that oil output improved to a lesser contraction of 0.85% from 22.67% that was seen in the third quarter of 2022. We believe that the fact that the government has also started to improve security measures along oil infrastructures is another factor that has led to this uptick in output volumes for the oil sector. For 2024, we believe that we'll be seeing a slight improvement in oil production, and this expectation is hinged on the fact that we believe that the commencement of local refineries is going to lead to increased operational effectiveness for the oil sector, and we might be seeing an increase in our output. Also, the fact that the federal government is trying to bring in investors into the oil sector, doing a lot of ventures. We've seen the federal government go into agreements with countries like Saudi Arabia, Germany, even with international companies like the Allsev Gas Limited, Indorama Eleme Petrochemicals, and all that, just to foster increased production and utilization of natural gas in Nigeria. We believe all this will filter into, improved oil output for the Nigerian economy in 2024. And as a result, we expect, our projection for oil output in Meristem is an average of 1.55 million barrels per day in 2024. However, for the non-oil sector, we are a bit cautious because, the factors that pressured the output in the non-oil sector in in 2023, some of these factors are still existent. We believe that inflation is still, our expectation of inflation, expectation of a further depreciation of the naira, and a lot of these things will keep the manufacturing activities constrained, as business owners will still continue to witness elevated cost of operation, finance, and the likes. And we believe that the growth for the manufacturing sector is still going to be sluggish. Even the agricultural sector, we still expect that the inadequate infrastructure, all those things that have been plugging the agricultural sector is still going to lead to sluggish growth for the agricultural sector in 2024. However, we believe that for the ICT sector, the real estate sector, we believe that the financial services and even the mining and quarrying sectors will witness improved output and improved growth in 2024. Also, alluding to the fact that this administration, as they've disclosed their intention to actually achieve a $1 trillion economy, we expect that this might lead to a likely rebasing of the GDP basket to include subsectors that were not properly captured in the 2009 GDP basket and construction. So we believe that all these things will come together, and it gives us our expectation of a 3.42% growth in the Nigerian economy for 2024. Moving to inflation, the price levels remained elevated in Nigeria throughout 2023, as we saw that inflation increased for the 12th consecutive time in December 2023 to 28.92% from 21.82% that we started the year with. Factors that are fueling this increase in the upward trajectory in prices, in general prices and of goods and services in the economy include the inadequate infrastructure that we've seen in the agricultural sector, insecurity in food producing regions, which continues to reduce output for food products, and also the fact that we saw adverse weather conditions during the year. All this just culminated into higher food inflation during the year. Also, we know that the further depreciation of the naira, which is, as an import-dependent country, the fact that naira keeps depreciating against the dollar leads to the higher import bills, which sort of affected prices of general goods and services, especially those that are imported. All these continue to, lead to a higher trajectory of inflation in 2023. For 2024, we believe that the factors driving inflation remain persistent. There is still this inadequate infrastructure for the agricultural sector. Security in food producing regions is still not so good. So we believe that inflation will maintain this upward trajectory. And also the fact that we expect a further depreciation of the naira is another thing that we expect to drive high price levels in 2024. However, we would like to point out that the government's initiatives to improve food production in the country, such as the acquisition of a loan from the African Development Bank for the production of wheat, and the fact that the government, gave instructions to the Ministry of Agric to distribute seeds to farmers ahead of the planting season. We believe all these factors might improve, the levels of outputs that will be seen in the food sector in 2024, and this could lead to lower food, not a reduction in food inflation, but a slower pace of growth for food inflation in 2024. Also, we'd like to point out that the high base effect of 2023, seeing that we've recorded inflation as high as 28.92 in 2023, will sort of moderate inflation figures that we'll be seeing in the second half of 2024. For monetary policy, seeing that inflation kept trending upward and maintained its northward trajectory, the monetary policy, in its bid to combat inflation, they implemented a cumulative of 225 basis point hike in our monetary policy rates. Also, we saw the monetary policy adjust the asymmetric corridor. We saw them raise the $2 billion limit on the standing lending facility, all to just mop up liquidity in the system. We also saw that the monetary policy, resumed the issuance of open market operation bills, that's OMO bills, just to mop up, liquidity in the system and just contribute to maybe a slower pace of inflation growth. And all this, we believe, would continue to see them in 2024. We expect the monetary policy for 2024 to do a maximum of 200 bps increase in our monetary policy rates. We also believe that the Monetary Policy Authority will be, doing a lot more of issuance of OMO to mop up liquidity in the system and rein in inflation for Nigeria. Moving on to the fiscal space, we note that we note that in the fiscal space, revenue performance for Nigeria in 2023 was not so bad, as we saw non-oil revenue actually overshoot the budgeted prorated 9M expected revenue. We believe the major contributor to this is the improved tax structure that we've seen that we saw towards the end of 2023 due to the inauguration of this new tax committee that led to with their aim of consolidating our tax revenue and just improving the tax structure of the nation. Believe all these are the things that contributed to the increased revenue we saw. However, we note that oil revenue continues to come up below budget, and it sort of alludes to the fact, it's just owing to the fact that we've not been able to meet up our quota of our production quota, and also, we've been doing below levels of what is actually projected in budgets for years now. So for 2024, we believe that the fact that we expect a slight improvement in oil production volumes would actually boost our oil revenue for 2024. Also, we believe that initiatives by this tax committee to harmonize our tax revenue across all levels and broaden the tax bracket would also lead to an increase in non-oil revenue that will be recorded for 2024. However, we do not expect the government to be able to, get up to the 19.25 trillion projection of revenue, because we believe that the country cannot produce up to the 1.78 million barrel per day of oil that is projected in the budget, in the 2024 budget. We believe that, despite the fact, just if we're moving away from the fact that we might not be able to optimize operation to just go from levels of 1.45 million barrel per day to 1.78. The fact that the OPEC, in its quest to also keep oil prices competitive, they gave voluntary cuts to different countries, with Nigerians OPEC quotas staying at 1.5 million barrel per day. We believe this is also already putting us at a disadvantage, as we do not have the luxury of even doing up to the 1.78 million barrel per day. So if we cannot do up to that, definitely we will not be able to at least make up to the projected revenue of 19.52 trillion. So we expect the fact that we won't be able to raise as much as expected to prompt the government, to come into the domestic fixed income market, to do a lot of borrowings, local domestic borrowings, just to be able to fund the fiscal deficits that we expect to be higher than anticipated or than projected by the federal government. We also believe that the government, by be accessing the ways and means window to, just to fund the deficits that will be seen in the 2024 budget, we believe the government has access to up to 1.80 trillion naira, which is 15% of the previous year revenue, since the threshold has been increased from the previous 5% to 15%. So we believe that based on our own projection of a revenue of around 11.54 trillion for 2023, we expect the government to have access to up to 1.80 trillion naira in 2024 under the ways and means. We believe that the government will also be accessing loans from bilateral and multilateral organizations like the WHO, the IMF, all just to fund deficits, the fiscal deficits that will be seen in 2024. For the country's external sector, we note that the external sector position for Nigeria has been weak. The sector has been characterized with lower capital inflows, as we believe that investors' optimism towards Nigerian securities have waned due to the liquidity of our market, of our foreign exchange market, and a lot of other factors that are highlighted by weak macroeconomic indicators. So we believe these are the factors that have contributed to the lower capital inflows that we saw in 2023. However, we note that our trade surplus position actually increased by over 1,800% in 9M 2023. And we believe that the major contributor to this increase in our trade surplus position is the depreciation of the naira in 2023, which led to a higher value of exports. and even made imports more expensive, so led to a reduction in the volume of imports. So all this culminated to improved trade surplus for 2023. So going forward, we expect our trade surplus to still increase in 2024, as we believe that the commencement of oil refineries will lead to a reduction in our import of oil products, and the further depreciation of the naira will also contribute to higher export value and just lead to higher trade surplus for the country. For our naira, our outlook for the naira in 2024 is modest. We believe that factors that would, contribute to maybe a mild appreciation in the naira, upside factors for the naira would include the further settlement of the backlogs, the CBN backlogs, the forward backlogs that the CBN started in 2023. If we see a further settlement of these backlogs, we believe it might lead to a mild appreciation of the naira. Also, we note that investors will be on the lookout for higher fixed income yields, as this, especially with the fact that we expect rate cuts towards the end of 2024 for advanced economy. We believe if our fixed income yields are higher, it will just increase the attractiveness of Nigerian instruments for foreign investors, and might lead to higher capital inflows, and even increase the central bank's the capacity to intervene in the foreign exchange market. So putting all these factors together, we've come up with a range of 892 naira to 924 naira to a dollar exchange rate range for 2024. Thank you. So my colleague Sadiq will be taking you further into what happened in the market.
All right. Before then, thank you very much, Felicia. Well done, Felicia and Esther. I mean, that was a fantastic conversation and insights, and I believe that the audience are also enjoying the conversations that are going on. I mean, salient points, a lot of things to pick out, and I believe that everyone is taking notes. I also took my notes. I hear expectation for 2024 for the global economy, where Esther mentioned about expecting a slowdown in inflation, and then also slowdown in growth, and also for the domestic economy. I hear where Felicia was mentioning part of the expectation for the year, and a couple of things jumped at me. First, improved oil sector performance in 2024, likely rebasing of the GDP basket, price levels to remain elevated in 2024, 200 basis increase in NPR, and then the likelihood of the federal government to assess the Ways and Means window. I think that is something we need to talk about during the Q&A session. I mean, because from the past administration, we spot a lot of issues, and then we also see the base case for exchange rate at 907 naira. I mean, interesting conversations. Before we go into the markets, we'd like to interact with our audience. We know that we have a diverse base, a broad base of audience from different parts of the country, and also from different continents. So if you're listening, can you just quickly type in the chat box where you are listening from? Just so that we can just, be in sync. Just type in the chat box where you're listening from, and also type your favorite investment vehicle. In the next 60 seconds, let's just go do that. Just type in the chat box where are you listening from, what state, what country, and your favorite investment vehicle. As you type, if I see them, I'll just call them out. You can help type in the chat box. I know who will go first. Who goes first? Type in the chat box where are you listening from, and what is your favorite investment vehicle? Or you can use the Q&A. You can type in the Q&A. I'll also see from the Q&A. You can type in the Q&A where you are. Okay, I can see Chiamaka Kore, you're listening from Lagos, Nigeria. Type in, you can use the Q&A. Oh, Felix from Port Harcourt. You like Transcorp. All right, we'll give you enough insight from Transcorp. Favor, you're listening from Lagos, Nigeria. Oluwaseun, you're listening from VI, and you use the Meritrade app. Oh, fantastic. Chiamaka, your favorite investment vehicle, equities? Oh, that's cool. A lot of people are listening from Lagos. I can see Bolade, Additional, Samuel from Lagos. Oh, Kolawole from UK. Nice to have you around. Equities, you have a lot of interest in equities. Chima from Kaduna, Nigeria. Nice to have you. You have Valentine from Lagos. Momi from Port Harcourt. Kenny from Lagos. You have Omolade from the United Kingdom. It's a pleasure to have every one of you listen to us. We also have Azumta from Abuja. Okay, Chigozie listening from Lagos. Pelumi all the way from Miami. Favorite investment vehicles, the money market. Oh, you're a safe player. I see that. We also have Samson from Edo State. Meristem, my favorite. It's a pleasure for to have you. We also have Ladi from Abuja. Yeah, Adekunle from Akure, Eunice from Abuja. Welcome. We also have an anonymous attendee saying his favorite investment vehicle is derivatives. Oh, fantastic. Fatima from Lagos, Paul from Port Harcourt, Ademola from Ibadan. I mean, you could see our clients from all over the places. I wish we have all the time to mention every one of them. You are all welcome, and thanks for participating and listening. All right, moving on, having gleaned insight on the happenings in 2023 and also particularly expectations for 2024 from the macroeconomics, we would now move on to the markets, the fixed income and equities market, to garner, insights on market performance for the year. And then I also know a lot of people have burning questions around the equities market and the fixed income market and even the macroeconomic environment. So you can please drop your question in the Q&A session. I see some people are raising their hand who might not be able to unmute you to speak or ask your question. So just kindly type your question in the Q&A box. Would attend to the questions appropriately. All right, so we'll move on to the markets, and also we'll be having the strategy section where our experts will run us through strategic investment opportunities and positioning for 2024. All right, so Dick, you have the floor now for the equities and fixed income market.
All right, good morning, everyone, and thank you, Samuel, for the introduction. So, as Samuel has mentioned, I will be taking us through the review and outlook for the markets, the equities market and the fixed income market, starting with the global market. Last year, that was 2023, the global equities market was pretty positive. The sentiment was largely positive, as shown on the charts by the right. You could see that the expectation of more accommodative monetary stance from major monetary authorities across the globe encourage investors to, take advantage of risky assets. And as you can see, comparing the performance of the equities markets in 2023 to 2022 just shows the broad and divergent actions from investors across this globe. And again, we saw that in the US markets, the so-called Magnificent Seven, which majorly are tickers around artificial intelligence, gained traction in 2023. We saw their market cap, the 7 tickers combined now account for about 12 trillion market cap, 12 trillion USD market cap. And they were, really instrumental in the positive rally that we saw in the global equities market. Again, the lower inflation rates and the lower inflation rates that we experienced in 2023 was also very, very, served as a very good catalyst for the positive rally that we experienced in 2023. In 2024, we are expecting that the global equities market will remain positive. However, we don't expect it to be as positive as we saw in 2023. And major drivers for this lower but positive growth that we're going to see in the equities market, in the global equities market in 2024 are, we're going to expect, slower growth in advanced economy, and this should have ripple effects on the corporates. And also, we are seeing higher, we are expecting higher than longer, interest rates, despite the fact that we are likely to see rate cuts at the later end of 2024. We expect that borrowing costs will remain elevated for the larger part of 2024, and this would rock, finance cost of these banks and should suppress profitability for these companies, and should suppress profitability for corporates across the global equities market. For the domestic equities market, the sentiment was equally positive. And as we can see, when we compare the Nigerian equities market to its peers in Africa, we'll see that it just sits second only behind Egypt, that did about 65%. The Nigerian equities market did 45.9% in 2023, and that's also, further speak to the positive rally in 2023. Despite the slower growth that we experienced in 2023, the bumpy roads, as we highlighted in our half-year outlook, the equities market was really, really positive. And we highlight several drivers for this positive move. Number one is, the twin fiscal reforms that my colleague had highlighted earlier. One is the subsidy removal that really pushed the oil and gas sector to be the best performing sectoral index in 2023. And the second one, which is the unification of the FX window, right, which supported, FX evaluation gains for banks. And that also helped the banking sectoral index be the second best performing index in 2023. Also, we had good corporate financial performance across, across several tickers, majorly the banking tickers, as I mentioned earlier, that had recorded triple-digit gross earnings growth and profit after tax growth in 2023. Lastly, we have several corporate actions that shaped 2023, and as you can see, we highlighted some of them on the slide. We can't but mention the rally across Dank Sugar and NASCON after the announcement of its proposed merger, right? We saw how that really impacted the consumer goods index. Also, we have the share buyback for Danksem at the beginning of the year. We have listing of VFD Group and Mikio. We have several delistings from Adova, Capital Hotel, Courtville, and Union Bank of Nigeria. As well, we have capital raise from several other companies in 2023. One other major dynamics that we saw in 2023 was the trend in market participation. We have seen an improvement in retail investors usually, and even till now, we have institutional investors dominate the markets. They have been the major player in the equities market. However, in 2023, we saw retail investors, increase their participation level to about 30%, compared to about 23% that we started the year at. That also speaks to how retail investors are gradually coming into the market. For 2024, we're expecting that the markets will be positive as well, although we're expecting a lower positive rally in the market compared to what we saw in 2023. Key drivers for our expectation remain positive corporate earnings. We expect that across sectors, we would see corporate performance, gleaning to the recovery that we are expecting for the economy and across sectors. When I speak about sectors, I like to highlight the industrial sector, the real estate sector, the banking sector, insurance sector. Those are key sectors that we believe would push the positive corporate earnings that should also support the positive market sentiment that we are expecting in 2024. Also mention the macroeconomic fundamentals. When we talk about recovery across several sectors, this is expected to bring positive sentiment to the market. We're expecting more corporate actions, more equity funding, and new listings. We are looking at more government institutions to list in the market in 2024. We have, banks of NNPC already showing interest in listing on the, on the Nigerian exchange in 2024, and we expect that to really spur buying activities. Speaking to corporate actions, we've seen, a couple of them already. We have rights issues from some of the banks. We have acquisition and, intention to acquire from Access Holding and, some other corporate actions that we are, likely to see in 2024 should also push that positive value that we are expecting in 2024. Also, all of this, the good news that we are looking at should, pick the interest of foreign investors, and we are expecting increase in foreign investors' participation in 2024. And in total, we are looking at our 2024 expected market return at 15.5%. Going further down into the, breaking it down to see how we arrived at the 15.5%, we have the fundamental approach, looking across several sectors, as I said, and looking at our the prices that we believe, are fundamentally justified across several sectors, the expected returns for them. And obviously, because of the turn that the market has taken in recent times, we also have to consider technical indicators. And as such, we use the Fibonacci extension indicator to arrive at some 17.77%. And at the end of the day, weighting this return makes us arrive at an expected return of 15.5% in 2024 for the Nigerian equities markets. Going to the fixed income markets, for the global fixed income markets, it was also a very good time for the fixed income markets, in advanced economy. Majorly, we saw that the inflation rates trending downward just signal to investors that the monetary authorities could be taking accommodative stance earlier than expected. However, we still saw some rate hikes in 2023. And as such, that turned US Treasury yield curve to be inverted. We saw the two-year notes having higher yield than 10-year, the 10-year Treasury notes in 2023. Also, when you look at several investment opportunities in the fixed income markets, we saw that the high yield global high yield bond actually recorded the highest. However, we saw several other, fixed income instruments, gain during the period. We have the investment grade instruments, we have high yield. Also, when you look at emerging markets, we saw that the emerging market hard currency bond actually outperformed the emerging markets local currency. And that sort of also informed our expectation for 2024 for this respective fixed income instrument. So for one, we say that for global investment grade bonds, we are much more positive for them, and we expect them to outperform the high yield bond in 2024. And our reason for this is, as I said, we are expecting slower growth for the global economy. We are expecting that borrowing costs will remain high, and as such, refinancing costs may be higher for high yield bond than investment grade bond. So we are looking at that. We are looking at investment grade bond to outperform high yield bond. Also for hard currency instruments, we expect that to remain much more attractive in 2024, and we glean more to emerging market hard currency bond than local currency bond. For the domestic fixed income markets, we saw treasury yields, touch historical level, and activity level generally in both the primary and secondary markets were really high in 2023. And for me, during the period, it was majorly activities from monetary authority that pushed this activity level. And my colleague mentioned earlier, we saw several liquidity management strategies employed by several liquidity management strategies employed by the CBN, and that is still expected to continue in 2024. And because of several squeeze on liquidity at occasional period during 2023, we saw yields touch levels that we haven't seen since 2019. In fact, in the secondary markets in November, we saw a 364-day notes touched 20%. And you would see with the charts that at that period, the view rate of return was narrowed. And I mean, that's a positive for, domestic investors, because with inflation rate trending upward, investors that are trying to lock in their money in fixed income markets would only expect that, yields will also compensate for that level. At the end of 2023, we saw average T-bills and average bond yield settle at 8.18% and 14.13% respectively, compared to 5.71% and 13% that we saw at the end of 2022. When we look at the Euro bonds in 2023, the performance of Nigerian Euro bonds in 2023, it was largely positive. And this was majorly pushed by the fiscal reforms. I mean, it's signal to investors that, the Nigerian government is looking to, take actions in order to help restore balance. And as such, we saw longer dated Euro bonds really perform well. We saw with the February 38, we saw with the February 47, January 49, and September 51. And as you can see, on the chart as well, everywhere is green across the, Nigerian Euro bonds market. For 2024, we are expecting, that sentiment to continue. We expect that youth level will remain elevated in 2024, especially in the first half of the year. We are expecting MPR we are expecting the Monetary Policy Committee to hike MPR by a maximum of 200 basis points. We are also expecting that the CBN would continue its liquidity management strategy. I mean, the CBN governor has, mentioned many times of how the Apex Bank is very stringent with it and how they have 8 a.m. meetings every morning. So we expect that will continue. We expect, occasional excess CRL debit from banks, and this should squeeze liquidity level in 2024. And as such, our expectation for, treasury bills, average treasury bills at the end of 2024 should be within the range of 9.59% to 10.59%. And for average bond yield, you expect to see it around 15.54% to 16.54%. For Euro bonds, we're also expecting that the sentiment will be largely positive. I mean, our expectation for weaker USD and our better outlook for the Nigerian economy, largely supports our outlook for the Nigerian Euro bonds in 2024. And that brings me to the end of my review and outlook for the Nigerian financial markets. My colleague Praise will now be taking us through the investment strategy for 2024. Thank you for listening.
All right, thank you very much, everyone. Thank you very much, everyone, for joining us and being on the call so far. I'm sure a lot of insights have been passed across in discussing the macros, the markets, and now we'll just basically discuss the investment strategy that we've put together across the equities markets and the fixed income market for investors in 2024. For the equity strategy, we've selected a couple of stocks based on a couple of criteria. These stocks are required to meet at least 6 of the criteria we've listed here. We expect, we looked at stocks that have had consistent years, 3 out of 5 consistent years of earnings and revenue growth. We look at our expectations for their top line and bottom line growth in 2023. Also, of course, our expectation for what the company's performance is going to be at the end of 2023. We look at stocks that have beta, that is systematic risk that is greater than 1, and of course, we also look at our expected dividend payments for these stocks. So putting all this criteria together, we've come up with a strategic portfolio. We've come up with a strategic portfolio that includes these particular stocks across different sectors, the economy. We have stocks in the banking sector, consumer goods sector, the industrial goods, and then of course the healthcare and telecom sector put together in this strategic portfolio. And our expectation is that with this strategic portfolio, we would have a total return of 21.08% for investors that invest in this strategic portfolio. Also, we put together a portfolio of stocks that we consider eligible for marginable securities, and then we call this margin stock portfolio for 2024. And this also comprises different stocks in the
in the banking sector, industrial goods sector, and just cuts across and gives return across different sectors, as identified, to spread the risk across different sectors. And of course, this stocks for the margining portfolio have also been put through a lot of tests, the liquidity tests for the market. I've also put these stocks through our expectations for their fundamentals in 2024, and of course our expectations and our evaluation of what the company has done in the past years. All right, moving on to the fixed income strategy. For the fixed income strategy, in line with everything that's been said during the presentation on fixed income, we expect that, with the rate cost that is expected in the second half of 2024, it would benefit an investor to position both on the short end and the long end of the curve. And that's why we came up with a barbell strategy. And the barbell strategy is, just basically advising investors to, select fixed income instruments with modified duration of lower than market average, and of course, high yielding long duration instruments. With this strategy, investors would be able to benefit from short-term instruments that have high yield right now, and then of course also long-term instruments that are looking at high yield right now before the projected rate cuts in global economies at the end of 2024. And we've put together our different types of instruments and our outlook on this instrument. We're positive on US Treasury instruments. We're positive on investment grade corporate bonds, and we're also positive on EM hard currency bonds, like Sadiq mentioned during his presentation. Also, we looked at the Eurobond instruments in sub-Saharan Africa and some countries that we recommend for investment in the Eurobonds market. I mean, we've put together our recommendation for Angola, Nigeria, Rwanda, and South Africa. And then these are the countries that we recommend investments in their Eurobond instruments. For Egypt, Ghana, Kenya, and Zambia, right now they are facing some of these countries with their macroeconomic fundamentals and the default risk, our expectation for the default risk. We don't, recommend investments in these countries' Eurobond at this time. But of course, one of the main things that we do here is to keep on the pulse of tracking macroeconomic fundamentals in these countries, and then we update as things change. And then on the countries that we've particularly selected, that's Angola, Nigeria, Rwanda, and South Africa, we've chosen some specific instruments that these countries, Eurobond instruments, these countries that will be eligible for, a fixed income portfolio in 2024. And then, we also put together our recommended fixed income, the optimal fixed income portfolio, and what the proportion of investment should look like. We're proposing Eurobonds of up to 30%, commercial papers up to 25%, corporate bonds up to 10%, treasury bills up to 20%, and then FGM bonds up to 15%. So in our view, this is what an optimal fixed income portfolio in 2024 should contain, because it helps investors to hedge against Naira depreciation. It helps, some of these stocks have low liquidity. It helps hedge against low liquidity, and then gives competitive rates of return. Lastly, on Nigerian Eurobonds, we consider some specific Nigerian Eurobond instruments that we think will be eligible and would be optimal for a fixed income investor in 2024. Looking at their closing yield of 2023 and what we expect for the yield for 2024 to look like. Of course, this also goes in line with our strategy of a barbell strategy of positioning both, on the long end and the short end of the curve. And we've selected stocks with modified duration of lower than 3 years and then higher than 5. So this gives investors a range of being able to play on different ends of the fixed income, on the Nigerian local bonds curve. And these are the instruments that we recommended. Thank you so much for joining our presentation today. Samuel, over to you.
Wow. Thank you very much. Thank you very much, Sadiq and Praise, and thank you to the whole research team. That was a fantastic presentation with a lot of insights. Now we'll move on to the Q&A session. I can see some questions in the Q&A session already. So if you have questions, you can just type them there. Read one. I see that you're raising your hand. Just kindly type your question in the Q&A box, and then we'll respond to them appropriately. I can see Olusegun also raising his hand. Just help type the question, and then we answer appropriately. So I will just kickstart the Q&A session before I now move to the box. I mean, a lot of burning questions around the equities market for this year and the performance. I see the expectation is for the equities market to be positive for this year. And true to that, at the start of the year, we've seen the market have been on steroids, recording gains and week on week. But the question is, this question goes to Sadiq, how sustainable is this performance of the market? Do we expect this performance to be sustained all through the year? Are there fears of maybe the repetition of what happened in 2008, the market crisis? Are there fears around, concerns around that? Are we expecting to see a bust in 2008, that happened in 2008 in 2024, given the way the equities market started in 2024? Then also the foreign participation, we are seeing a little bit of improvement. So a little bit of improvement in 2023. In 2024, are we going to see more foreign participation into the equities market? I mean, that's the first question. So I think Sadiq, you can take that.
Hi, Samuel. Thank you for your question. All right. So yes, I hear you. And concerning the question around, the activity level, the very, very positive rally steroids that we've been seeing in the market in 2020, so the beginning of 2024. Again, I mean, it aligns with our expectations somewhat because we are positive about the Nigerian equities market in 2024. However, as I mentioned during the course of my presentation, that we are expecting it to be at a slower pace compared to what we saw in 2023. The question will now be if it has, now at this point, we've seen it do 20% year to date. Is it sustainable? For me, we would say that at some point during the year, we'd expect, market correction. They expect that investors will also take profits. I mean, that's just the psychology of the equities market. We've seen it happen before. So they expect that, some investors will take profit. As we said, there are some of these stocks that are currently trading at prices that are not fundamentally justified. Again, we would be having 2023 full year financials come out in a couple of months' time now. And investors would be looking out for, the stocks that they've taken position in. They want to see the results actually being able to justify, the price. And it's just normal, rational for investors to want that. I mean, if Etika is trading as high as, it's trading as high as 40 naira, and you are paying a dividend of 40 kobo, 50 kobo, that could spoil, reaction and could for profit taking from Etika. So during the course of the year, we are expecting market correction. However, on a broad scale and overall in 2024 generally, the Nigerian equities market should remain positive. And second question, again, just to address, we don't expect any fear of crash or a replica of what happened in 2008. No, we do not see that. So to answer the question about the foreign investors' participation, yes, we are seeing gradual recovery. In 2023, we saw the symptoms. At some points, we saw foreign investors bring in money. And again, when the conversation around backlogs and CBN with the intention of, especially when conversation about our external reserve and, how low is it, how sustainable is it, when it came, we saw investors, hold back again. And during the time where there was this declassification of Nigerian equities indices from MSCI and FTSE Russell, we also saw pullback from foreign investors. However, at the end of, the most recent data that we have from NGX in November, we saw, foreign investors' participation reach higher levels since we've seen in like 2 years now, which also speaks to the fact that foreign investors, appreciate the fiscal reforms that are taking shape. However, they need concrete evidence in order for them to bring in that money, because the fear of repatriation can push them away from the Nigerian equities market, which is why we are also expecting that would drive activity level in 2024. We're expecting that the reforms will start seeing more fruit yield in 2024, much more recovery than we saw in 2023, and that should make our financial markets more attractive and should attract foreign investors into our markets in 2024. Thank you.
Thank you very much, Sodiq. That was a fantastic response, and also, like I predicted, I knew a lot of questions will be coming in around the equities market, given the performance so far. I could see a lot of questions around when are we going to see or expect to see correction in the equities market, and I also see a question from Keldeni saying that most of the companies have already surpassed or almost at the 2024 target price as stated in our outlook report and strategic portfolio. So Kedelis went on to give example of Cadbury and also for ICO. So the question is, were you very conservative in your prediction? And are we going to see a review of the 2024 target prices? Or should we still bet on the 2024 target prices as stated in your outlook? So somebody can just take that very quickly.
All right. Thank you. Thank you very much, Sama, for your question. And it's interesting because obviously we are aware that the performance of the market at the beginning of the year, as I said earlier, has done about 20% year to date. Begs the question of, are we actually conservative? But the truth is, when we look at it from fundamental standpoint, which is the major, the major way we look at the tickers, and the way we arrived at our target prices, these are the target prices that we believe are, fundamentally justify the performances of these tickers. Again, as I said, companies will release their financials, in a couple of months' time. And also, it's further begs to, it adds credence to our, to our outlook for these stickers. For specifically speaking to Cadbury, I mean, that was we saw that recent move following, the recent corporate action about the conversion of its debt to equity. So, it's very possible that you would see, that rally across the tickers. Again, as I said, the market is very, the activity level have increased. There are also technicals pushing it. However, from fundamental standpoint, we've justified our TP, and yes, can say you can take a bet on our 2024 TP.
And at least you can take a bet on our 2024 target prices. Okay, let's move away from the market and just just delve into the domestic macros. I can see a few questions from Juliana. Juliana is asking, following the Dangote refinery launch, I mean, that was a conversation that was on front burner last year, and we saw the launch also last year, and then we got information that the refinery has started operations. Now, following the launch of the refinery, can you list some of the domestic prospects that were selected for the petroleum distribution? I think that question is speaking to the impact of the launch of the Dangote refinery. So hold that question on one hand and also take this question. What is the likelihood of domestic inflation reducing this year, even when the major causes have not been attended to by the government? So we can quickly take that question on domestic macros.
Thank you for your question, Samuel. So with the commencement of operations in the Dangote refinery, we are expecting this commencement to actually impact activities in the downstream oil and gas sector, and also in the upstream oil and gas sector as well. Well, for the upstream oil and gas sector, with the upstream oil and gas regulatory authority has issued a compulsory domestic crude supply obligation to the upstream companies to kind of like bolster the refining capacity of these refineries, and we expect that this would increase the supply of crude to these refineries, and it is just one of the factors that will bolster investors' participation in the upstream sectors, as we've been seeing a lot of investments coming into that space. Also, for the downstream oil and gas sector, since NNPCL is the first participant in the exchange of crude for refined products with the Dangote refinery, of recent, I think this morning, the Etana PLC also, yesterday, Etana PLC has joined as one of the marketers that will be getting refined products from the NNPCL from the Dangote refinery. So we expect this move to kind of like help the downstream sector in their source of refined product, because we know initially the refined product are usually sourced from outside of the country, and due to the limited availability of FX, it has kind of reduced their capacity to import fuel into the country, and NNPCL has been the sole importer for a while now. But with the refineries coming into play now, we see that there will be more participation of oil marketers in the downstream oil and gas sector as well. So we expect this to actually lead to a likely increase in revenue for downstream sector, because some of their increase in earnings for downstream oil and gas sector, because some of their cost components like freight and some transportation will be reduced. But however, considering that there's still that tendency of narrow profit margin in the industry, we foresee that cost of sales will also increase as well. So, but all in all, in the downstream oil and gas sector, we expect more participation in that space, and we expect this to actually bring in more investors, foreign investors, and even domestic investors into that space, as there's now LD price competition among players, and this will just mean more ability to achieve higher margins for players in the downstream oil and gas sector. Thank you.
All right, fantastic response from Esther. We also I also had a question on inflation. What's the likelihood of domestic inflation reducing this year? I mean, given that the major drivers have been unattended to by the government.
Thank you very much, Samuel. So for inflation, yes, we understand that some of the drivers of inflation have not been fully attended to by the government. That is why we expect, at least for the first half of the year, inflation will continue its upward trajectory. However, if we check the trajectory of inflation in 2023, we note that towards the second half of the year, inflation numbers started to trend really high. So we believe that the base effect of the high inflation numbers that the economy saw in 2023 would be what would moderate inflation figures, year-on-year changes in the second half of 2024. We don't expect price levels to drop. We don't expect to see maybe a decline in inflation, but we expect to start to see moderate figures in 2024 H2 as the effect of high inflation numbers that we witnessed in 2023 begins to moderate the year-on-year figures that we see. Also, we would say that the government is actually improving their measures to increase, food availability, as one of the major contributors to headline inflation is the food index. So we believe that if these measures, these initiatives continue to at least yield, even if minimal, results, we'll begin to see inflation figures moderate, and the pace of inflation increase would slow down towards the second half of 2024. Thank you.
Thank you, Felicia, for that insightful response. More questions are rolling in. Thank you very much. Please keep dropping your question in the Q&A session. Our analysts will attend to them, and we'll also attend to some live. All right, I see a question from Salvador. He's saying, I would like to know your views on the exchange rates policy of the current government. The objective was to let the Naira devalue and reduce the gap with the parallel exchange rates. At the same time, the objective was to contain inflation. Now, in your opinion, do you believe that such a strategy is realistic and doable? Yes, that's the question. Do you believe that such a strategy is realistic and doable? Thank you.
Hello, okay, thank you very much for your question, Samuel. I mean, a couple of the activities and plans that the actions that the government has put in place to curb and help the exchange rate market. Largely, they're expected to yield positive results at the end of towards the end of 2024. This is premised on the fact that the former way that the exchange FX market was running, we having different windows in parallel markets, and then having different windows on the official markets, and also having items that banned from sourcing FX on the official window. These were factors that broadly also led to the widening of the gap between the official rate and the parallel market rates. And yes, I mean, it's going to take some pain points to be able to achieve this, because largely to be able to achieve the reduction on the exchange rate and also reduce the gap between the official and the parallel market rates, that I mean, all the activities I've been carrying out right now, they are largely pain points that we need to go through, to eventually, and then if all these factors are eventually, thought well put together with the clearing of FX backlogs that's currently going on. I mean, a lot of FX backlogs that have been owed to airlines and banks have been cleared. So with all this clearing of FX backlog and with the removal of the ban on some items from sourcing FX on the official window, this should eventually help the exchange rates find a balance on both the official and parallel, and close the gap between the official and parallel market rate. Of course, we also know that one thing that's very important, to close this gap further is increased liquidity on the official window. We start to see some increase in liquidity on the official window. That's official FX coming into the official window increases. That would also move demand from the parallel markets to the official market. And so it's a function of demand and supply. And eventually, so all those factors put together, when implemented right, they are most likely to yield benefit results for the economy in the long run. And then, of course, exchange rates also plays a major factor in either increasing or decreasing your inflation rate in an economy. With the fact that we are also having the section of imported inflation in Nigeria, where prices are either increasing or reducing on the global economy, and then the exchange rate factor plays a major role in determining what the imported inflation is going to be. And then in the long run, like I just mentioned, should all these factors that we've the implemented policies and then continued implementation of these policies, and should they lead to the expected result of lower, reducing that balance and increasing the gap, reducing the gap, between the official and the parallel market rates, it should of course feed into imported inflation in Nigeria, and then that would help to stabilize imported inflation beats of Nigeria's inflation rates. But of course, we know that in Nigeria, we are not only dealing with imported inflation into the country, there's also the bit of the domestic challenges that we are facing. So these factors need to work hand in hand to be able to moderate inflation rates as expected.
Thank you, Praise. That was a very robust response. I hope that question was clearly answered. I also have another question from Babafemi. He's saying that with the projected slow-paced global growth of 2.9% for the global economy in the year 2024, what is your outlook for revenue bonds, considering that some states across the country might be exploring this strategy to raise funds for diverse developmental projects in the year 2024? So I think Babafemi wants to know what our outlook is for revenue bonds in 2024.
Thank you for your question, Samuel. So as the person had commented and as the question has asked, our outlook for revenue bond in 2024, that's for major states. We're expecting that we'll see these states actually record higher revenue during this period. Again, we would revert back to our expectation of higher growth for Nigeria during the period. I mean, that should also bode well for the fiscal, part of these states. And yes, we would see that one, obviously, because these states are going to try to meet their fiscal deficit. So yes, they would see that instrument be more attractive. In this case, the revenue bond, as as the question was asked, we should see it much more attractive during this period. The states, trying as much as possible to meet their manifestos, their agenda, and in using that to set up infrastructure and their developmental projects. So yes, we see it to be attractive in 2024, and we expect states to, as much as possible, take up that strategy in bridging their fiscal deficit.
All right, so I think that answers the question. But Femi, you're expecting that revenue bonds will be attractive in 2024. All right, so I said earlier that I was going to ask a question around ways and means, because I hear when Felicia mentioned that there's a likelihood of the government exploring that window, to finance some of its deficits. And we know that that conversation around ways and means was a very serious issue during the past administration, where they overshot the target. Now, if we are expecting that this present government would be exploring the ways and means to show up its deficit for this year, to what extent are we going to see that, and then how do we think that this will impact the market, especially the fixed income market for 2024?
Hello, Samuel. Thank you very much for the question. So yes, we note that the past administration actually overshot the threshold of 5% of the previous year's revenue for accessing the ways and means, and culminated into this elevated figure of over 22 trillion naira that was securitized as ways and means accessed by the previous government. However, we know that this administration, from their posture and the fact that they've even gotten approval to increase the threshold to 15% of the previous year revenue, we do not expect this administration to overshoot the threshold of that 15% of the previous year revenue. And then, given our projections that the revenue for 2023 is going to come in at about 11.54 trillion naira. So we believe that the current administration, they have a capacity to access up to 1.80 trillion naira in ways and means to fund fiscal deficits that we believe we have, because we cannot meet up with our revenue, our projected revenue. And we expect this, to feed into what we'll be seeing for fixed income yields, given our broad expectation that fixed income yields will remain high in the first half of 2024. So it's just, we believe all these things will just, it would serve to, increase funding for the government budget, and also even attract foreign investors if our fixed income yields are high, and it just increases the attractiveness of Nigerian instruments,
All right, I hear you, Felicia. This time around, you're not expecting them to, from the conversation, to overshoot the target. Okay. Still on the fixed income market. I know that the expectation for this year is for yields to trend upward. But the question is, when are we going to see that? Because it appears that that's not what it is currently. When are we going to see that? What are the factors that would drive yields, upward, and how high can yields get to in 2024? And then again, is liquidity going to be a major driver to call the market direction? Because so far this year we've seen that liquidity interplay, driving and calling the market direction. Are we going to see a lot of that for the rest of the year in the fixed income market?
Right. Thank you very much, Samuel, for the question. Yes. So, I mean, for the if we just take it back to looking at data from history, we would see that at the end of the year and the beginning of the following year, we always very frequently we see the yields trend lower, and that is majorly because of lower offer from the federal government during that period, during let's say mid-December to the first week, so the first primary auction that you would see from the federal government, either through T-bills or bond, you will see that the amount on offer is usually lower than usual, and as such, that pressure yields to go downward. It could be a strategy, to as much as possible minimize borrowing costs. However, when you see going forward, as we would see in the next T-bills auction, you would see now that the amount of offer is now much higher. We'd see it range over, let's say, 200 billion, and again that when you weigh that in comparing it to the liquidity or subscription in the system, in our sort of call direction of rates during the period. If we are going to see liquidity be a major player or a major tool that calls the direction of yields in 2024, I'd say yes, liquidity in most recent period has been that major tool. And seeing that the CBN is also very, very keen on using that as a strategy to help drive inflation rates lower. And as I mentioned earlier, the CBN has reiterated time and time again about how it is very big on liquidity management strategies. Would say that yes, we are expecting liquidity to be a major force in the fixed income market in 2024. How high are we expecting the yields to go in 2024? We see average T-bills yield and average bond yields based on our forecast and our outlook during the course of our presentation. We see it to trend higher than the level that we saw in 2023. There are several factors that we are expecting to drive this. One, the liquidity management strategy, as I mentioned, our expectation of a maximum of 200 basis point hike in MPR. Again, we're expecting that the government would try as much as possible to bring in funds. And one way to signal to foreign investors that you're serious and you want them to play in their fixed income market is to help narrow real rate of return. And to narrow real rate of return when inflation rate is trending upward just means that your fixed income rates, whether in the money market or in capital markets, that's in terms of FGM bond now and T-bills, they have to also be high. So we expect the rates across these fixed income instruments to remain high. When we are going to see it, as I said, based on historical pattern and trend, we should start seeing that anytime from late January into February. Again, in March, we would expect that rates could a little bit go lower because of the maturity of FGM bond that we're going to see, the March 2024 maturity that we're going to see, during that period. So, but on a broad scale, we're expecting rates to remain elevated in 2024.
Thank you very much, Sadiq, for that response. I also have a question in the chat box from an anonymous attendee saying that, how do you think the proposed banking recapitalization by the CBN would affect the banking sector performance on the NGX and the economy at large? And that's pretty straightforward. Somebody can take that.
Okay, yeah, thank you very much, Samuel, for the question. And for it's also one of the expectations for us in the Nigerian equities market. We expect that to drive activity level. Although the central bank has not fully rolled out directives as regards how the recapitalization exercise will take place. Based on our estimates, we are looking at the CBN doing 10 times the current minimum capital requirements. We know for international 50 billion, for national 25 billion. So if we are doing 10 times, the last time we had recapitalization it was about 12.5 times. So if we are doing 10 times, we should see international minimum capital requirements be around 500 billion. Now, taking that estimate into context, what we see is that for tier 1 banks, they are pretty much comfortable because across tier one banks in this case now, we're talking about FBNH, the UBA, GT, Access, and Zenith. They have total equity above 1 trillion naira. So we see them pretty much very comfortable. However, we highlight some tier two banks which we believe could be under pressure. We've already seen some of them take proactive measure in order to raise capital, the likes of Wema Bank, the likes of Fidelity. We've seen them come out to say they want to raise capital through either rights issue. However, we still expect that some of these regional banks may undergo business combination or consolidation in 2024. Again, the magnitude of how it will affect activity level on the equities market would depend on the directive from the CBN. If it will fully take effect in 2024, then you'd expect that much more activity level than we are even currently seeing. One of the reasons why we've seen banks be one of the major tickers that have pushed the market so far in 2024 is investors trying to take position ahead of the capitalization exercise. When the full directive is out from the CBN, we could still see much more, activity level in the Nigerian equities markets.
Thank you very much, Sadiq. I see a lot of questions still rolling in the chat box. I want to assure you that our analysts will attend to all the questions we have in the chat box. And however, time is not so much on our side, and we need to wrap up the conversation. So we'll just take these final questions. As I see a lot of it, so I'll just summarize. I think that's a burning question in the mind of our clients and investors alike. So we have the question would be very, very specific, and that would be to strategic investment positioning. Now, for the equities market, what sectors would you specifically recommend for investors to play in 2024, and what stocks specifically and why? Then also for the fixed income market, I see that we're recommending the barbell strategy. And then I see that for the domestic market, we are seeing that investors should play in both the short end and the long end, and I'm seeing very high yield at the longer end of the curve. So for the Euro bonds, what would you recommend? Would you say investors should lock in high yields at the moment, given the expectation of lowering of the yield on the global fixed income market? And then for the domestic market also, what would you recommend for investors? Would you say investors should play at the longer end of the curve or at the shorter end of the curve? With that, would answer to those questions would wrap up the session. Yeah.
All right, thank you very much, Samuel, for the question. That broadly speaks to the investment strategy that we have, put together for 2024. And, beginning the question from the equities point of view, like I mentioned during the presentation, we have stocks across different sectors. It will not be optimal to concentrate your investment on a particular sector and then, ignore other sectors, because, we could have sectoral occurrences that could be, impacting one sector, but, completely miss the next. So on that premise, we put the strategic portfolio across sectors in the banking space. With the question that was answered before this, there was, we expounded on what we expect for the banking tickers for 2024. And of course, the sentiment around banking tickers are quite positive right now. And then, we expect that to continue. Of course, there'll be occasional bouts of profit taking in the markets, like we expect. It's largely to be expected. But then banking sectors are largely expected to, end 2024 on the positive fundamental note. Maybe not as high as 2023 because of the FX gains, but we are still going to see positive performance in the banking sector. And this also feeds into our expectation for their tickers and prices for the tickers by the end of 2024. Of course, the consumer goods sector was also one of the sectors that was largely pressured last year because of the currency devaluation issues that happened. A lot of consumer goods companies had loans, foreign loans in foreign denominated FX loans, and so they had to, they suffer FX losses on the debt and of course on the finance cost, which so, I mean, affected their books, and we expect that to affect their 2024 full year books, 2023 full year books, I mean, when the results are released. But in 2024, we expect a mild recovery in the consumer goods space, and that largely feeds into, the expectations for performance of the consumer goods stickers. We also know that there is the Dangote and NASCON measure that is coming on stream very, largely, it was announced last year and it's coming on stream this year. So that should also expected to, boost more performance and positive performance in the consumer goods sector. During the presentation on the macros, we also spoke about the energy sector and the expectations that there will be broad improvements in oil performance this year. The Dangote refinery coming on stream. The question was asked about domestic companies that would be, part of the Dangote refinery production value chain, refining value chain, and sharing value chain. And we know that Etana was also mentioned as one of the companies that has been approved for distribution. So that, and then the proposed listing of NNPC should also boost performance in the energy sector. For the telecom sector, we are positive on improvements in broadband, 5G usage, improvements in digital access across different sectors, and of course e-commerce penetration in Nigeria. So all these things feed into our expectations for these particular sectors. I've mentioned the banking, consumer goods, energy, industrial goods sector, of course, is also also positive on the industrial sector, because we expect more infrastructure projects, focused projects to be expanded this year that would bode well for stocks in the industrial goods sector. We have the likes of Danksem, we have WAPCO, we have JBeja, and these stocks, and they are all stocks that we expect to return positive returns this year, and these are fed into our strategic portfolio for the year. But like I said during the presentation on the investment strategy, the strategic portfolio is constructed to cut across different sectors and not concentrate on a particular sector only. So there may be stocks on the strategic portfolio, there will be stocks that are doing well, but did not meet the cuts for that particular sector, so it was excluded from the strategic portfolio. And so that's on the equities market. And for the fixed income market, the question was about yields in the Eurobonds market and how you advise investors to play in the Eurobonds market. Like we said during the presentation, there are a couple of investments instruments in the Eurobonds market that we have listed in different countries, especially the sub-Saharan Eurobonds market. And then looking at those instruments, we think that they have positive returns right now, and most of them are actually long dated instruments, long duration with long duration, instruments with long duration, I mean. And then we are quite positive on their macroeconomic fundamentals for Angola, for South Africa, Nigeria, and Rwanda. These are 4 countries that we have looked at their macroeconomic fundamentals. We looked at their currency, the strength of their currency. We've also looked at their reserve balance. Be able to see can the reserve cover their debts. And then looking at all these things put together, we put a recommendation for the specific stocks. I would see if I could still share the slide on the specific stocks that we recommended for the specific instruments, fixed income Eurobond instruments, I mean, that were recommended for Eurobonds in 2024. I would look at sharing that, and that could give a lot more color to the question on the Eurobonds. I don't know if there's any other question I'm missing, but I think I've largely answered the question across the fixed income markets, and then for the equities market also. So yeah, this is the slide that I mentioned on the Eurobonds for Nigeria, for SSA Eurobonds that we mentioned for Angola, for Nigeria, for Rwanda, and for South Africa. And so this largely covers our expected amounts. Their Eurobond, the amount that they have pending in USD, and the coupon rate, the maturity rate of these instruments, and then the time to maturity. And across this, you see that the lowest time to maturity here is 5 years, which just speaks to our strategy of positioning on both the long end and the short end. And then for the Eurobonds markets, for Nigerian Eurobonds, for Nigerian local bonds, we also, gave our specific recommendations for the Nigerian instruments and their forecasted yield for 2024. And like this shows, we expect the yields to be double digits in 2024 full year. So Samuel, I hope that answers the question on the instruments, and I'll stop sharing the screen now. Thank you.
Very, 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 very much praise and to the research team, and that was a very, very robust response. And I think that our investors and clients alike have gotten, insights as to the market performance and where to invest. All right, thank you for the presentation. All right, moving ahead, to take the closing remark for today will be our very delectable Damlona Hassan, the Managing Director for Meristem Trustees Limited. Damlola, you're welcome. You have the floor now.
Thank you. It's still morning time here in Lagos, Nigeria. So I say good morning once again to everyone who has joined this call. We appreciate your making our time to join us. I believe that it's been a very insightful time. We do not have the crystal ball, but what we do is to lean on past trends, lean on market information, and of course, leverage our experience in the capital market to put all of this together so that you can make informed decisions as you take on the year 2024, as you take on your financial goals. I believe that you have found the webinar useful. I know that after now, we'll be sharing the report via email with some of those of you who registered for this webinar. We'll be sharing soft copies of the Outlook. We are also available. Perhaps you want us to speak to certain groups. You want us to help them to address some of their concerns regarding how some of the decisions regarding your finances will pan out as a corporate or as an institution, as a family. If you want us to come speak to you, the team is very much available to do that, and it will be our pleasure. Thank you very much to the research team. Praise Samuel, Sadiq, Felicia, Esther, you guys have been wonderful. It's been a very, very useful time. Thank you for pouring out your all. We really hope and pray that the year 2024 will be a fruitful one. We hope that our anticipation regarding the economy and an improvement on the overall outlook, we pray that there will be that improvement and that our aspirations and desires for the year will come to fruition. Again, please check us out on www.meristemng.com for our robust services and products that you can take advantage of. And again, our contact details are there. Our email addresses have been shared prior to now. It will be shared again. Our email addresses, our telephone numbers. You can call us. You can send us a mail. We have a 24/7 contact center that is available to take your calls, to answer your emails. So please reach out to us. In Meristem, we are here to grow wealth for you. That is our promise to you. All along, it's been 20 years of promising that and delivering on that promise. We go again in year 2024 to deliver on that promise. So please ride with us as we do that with you. Thank you very much, everyone, and enjoy the rest of your day.
Very much, Damlola, and also thank you to everyone that joined in. We hope to do business with you. Some people are asking if you're going to share the presentation. Yes, we'll be sharing the presentation via mail to all our prospective investors and also prospective clients. Thank you, and have a very nice day ahead.
Building wealth isn't only what you do for yourself, it's what you do for generations to come. And to pull that off, you need partners. Partners who understand that the assignment isn't just to grow your wealth, but to preserve it against the harsh storms of life and ensure it sees the light of day, ready to be transferred from generation to generation. So you see, The art of building well is all about growth, preservation, and transfer. And at Meristem, we have perfected that art.
Meristem, let's grow wealth for you.
From taking their first breath, saying their first words, to taking their first step, life is a journey. A journey from using a pencil to a pen, from kindergarten to college, and from chalkboard to board. At Meristem, we can make that journey easy for you with our Meristem Education Trust, which allows you to set up a dedicated trust account for your children's education. With our Meristem Education Trust, you can rest assured knowing that neither debt nor incapacitation can hamper your children's education. To get started, kindly call us on 0700 Meristem or send us an email at trustees@meristem.com. Fear of the future and its uncertainties puts a lot of pressure on people. Pressure of safeguarding their assets and caring for their adults. What happens to your hard-earned assets in your absence? How do you protect your loved ones from extended family wahala when you're gone? I'm sure you've considered writing a will, but you're reluctant because you think it's a complex process. Well, did you know that in the time it took me to make this coffee, you can write a will? Sounds unbelievable, right? Yet very possible. We believe that nothing should hinder you from leaving a good life behind for those you love. With Meristem Simple Will, you can write a will that protects your assets and provides for your loved ones from the comforts of your home. All you need is an internet-enabled device. To get started, visit meristemtrustees.com/simple-will. At Meristem Trustees Limited, we are committed to ensuring your legacy lives. Fear of the future and its uncertainties puts a lot of pressure on people. Pressure of safeguarding their assets and caring for their adults. What happens to your hard-earned assets in your absence? How do you protect your loved ones from extended family wahala when you're gone? I'm sure you've considered writing a will, but you're reluctant because you think it's a complex process. Well, did you know that in the time it took me to make this coffee, you can write a will? Sounds unbelievable, right? Yet very possible. We believe that nothing should hinder you from leaving a good life behind for those you love. With Meristem Simple Will, you can write a will that protects your assets and provides for your loved ones from the comforts of your home. All you need is an internet-enabled device. To get started, visit meristemtrustees.com/simple-will. At Meristem Trustees Limited, we are committed to ensuring your legacy lives. The fear of the future and its uncertainties puts a lot of pressure on people. pressure of safeguarding their assets and caring for their loved. What happens to your hard-earned assets in your absence? How do you protect your loved ones from extended family wahala when you're gone? I'm sure you've considered writing a will, but you're reluctant because you think it's a complex process. Well, did you know that in the time it took me to make this coffee, you can write a will? Sounds unbelievable, right? Yet very possible. We believe that nothing should hinder the life behind for these you love. With Meristem Simple Will, you can write a will that protects your assets and provides for your loved one from the comfort of your home. All you need is an internet device. To get started, visit meristemtrustees.com/simple-will. At Meristem Trustees, we are committed to restoring your voice. The fear of education against uncertainty, pressure of safeguarding their assets and caring for their loved. What happens to your hard-earned assets in your absence? How do you